Hi, and welcome to Financial Thought Exchange, brought to you by the CFA Institute Research Foundation. I'm Larry Siegel, and I'm your host today. I'm also one of the research directors at that foundation. Our guest is Bill Sharpe, a man who needs no introduction, and I was tempted to say, and he will get none, but that wouldn't be right. Bill was the first winner of the Nobel Prize in Economics that for his work in finance, and he had to share that prize with a couple of other fellows you may have heard of, Harry Markowitz and Merton Miller. Bill is best known for the capital asset pricing model, which he came up with in the early 1960s, and which, after 60 some years, is still the foundational way of thinking about the relationship between risk and return. And I'd like to begin, Bill, by asking you if you can tell me where you, first of all, you might want to say what the model is, but also how relevant is it now after 60 years of testing, critiquing, supporting whatever has happened to the CAPM since you came up with it about 60 years ago?
Wow, well, I'm not obviously not conversant with all the testing, application, etc. I think basically it's not so much using it. The practical conclusion, of course, is just buy the market portfolio. Thank you very much, and lever it up or down to taste in terms of how much risk you're willing to take in pursuit of higher expected return. But I would say it's used, and I would also say misused quite a bit.
Why don't you go over that?
Okay. Well, one concept is the risk that you really need to focus on in a diversified portfolio, at least, is what's called now the beta risk. That is the risk that arises as the market moves. How does your stock move with it? How does your portfolio move with it? That is risk for which you will presumably be rewarded in the long run or in the short run with a higher expected return. And so the idea of beta as a measure of market risk, or more appropriately exposure to the risk of the market that a security or portfolio has, I think that's a valuable concept, and it's used pretty widely. The idea of diversifying away, or at least reducing as much as possible, the non-market risk, which presumably, according to the theory at least, for which you're not rewarded, and getting a portfolio that's highly diversified, where a lot of those non-market aspects are sort of diversified out, is, I think, fairly well accepted. That said, there are, of course, many differences, and I think it's useful to differentiate what we talk about there between the APM, which is an equilibrium model, has these characteristics, data diversification that we were talking about, and a more simple concept of just diversifying to try to get as much uncorrelated risk out of your portfolio, at least minimize. We can talk about that, but that was a long answer. I apologize.
No worries. I need to break from the conversation in a few seconds. I can't hear you very well, Bill. I'm wondering,
Really?
is your end?
Okay, well, I'm on a laptop, and so
Oh,
let me move closer. Is that better?
Oh, that's much better.
Okay, all right. You're going to have to see a larger version of me. I'm sorry.
That's just grand. I wonder if you could go back up and repeat some of your answer to the question, because I don't think we really got it.
Oh, okay.
Nate just texted me back to say that's much better. I thought the problem might be the internet connection, but it's not. It was just your distance from the monitors.
Okay, as I say, I'm not home. I'm at another place, and
Yeah.
so I'm on a laptop. I don't have benefit of more technology. Well, the CAPM is what one would call an equilibrium theory. In equilibrium, and of course, one likes to think that that equilibrium is a very good approximation of what's going on all the time. And the sort of the key notions are, first of all, that the optimal thing to do, at least in an ideal world, would be to buy the entire market. This is absent special information you might have, but for the normal investor, buy the entire market and then combine it with treasury bills or borrowing to get the level of risk that you're willing to take. But basically diversify away all the risks that go with owning this company only or that company only, and therefore diversifying away a lot of that non-market risk. And if in that setting, a key measure of not only the risk, but also the expected return on your portfolio is the beta of the portfolio. That is a measure of the extent to which, when the market moves 10%, are you likely to move 12%, 8%, or 10%? So if it's 10%, your beta is 1. If you're going to move 12%, your beta is 1.2, et cetera. And that is a measure not only of what I used to call market sensitivity, how you're likely to move when the market moves, but also, in the theory, a measure of your expected return, that the expected return on your portfolio should be the risk-free rate plus beta times the expected return over the risk-free rate per n of the market.
We can discuss what
Long
that
answer, and there'll be no test.
Well, the equity risk premium is always on the test, and of course,
okay.
That premium is what you just described. It's the expected return of the market in excess of the expected return of some riskless asset, whatever you choose to call riskless. Why don't we talk about that for a moment, because it's something on everybody's mind. Financial planning relies on it. Asset allocation for institutional investors rely on it. And recently, the Research Foundation hosted a symposium on the equity risk premium that was motivated by a fellow named Edward Macquarie, Ed Macquarie, writing an article saying that the equity risk premium isn't as high as you think it is. And he went through extremely detailed historical analysis to show that there were long periods when stocks didn't beat bonds at all, even the United States. And but basically, he believes that there's an equity risk premium, that it's a positive number, but that the high numbers that are often used in financial planning and asset allocation are unrealistic. What do you think the equity risk premium is numerically, Bill, for investors looking forward today?
Well, for the first answer is I don't know. Haha.
Yeah.
Hello, Marty.
Hello there, Bill. We got to stop meeting
you
like
answer
this.
the question. Did you hear it?
No, I didn't hear it.
Oh, darn. Okay, let me try it, and then let me just try. The question, as I recall, Larry, was what's the equity risk premium or the expected return over the riskless rate on the market? Is that fair statement?
That's what I asked. And
okay, well, I will.
Person who let me.
I'm going to expect Marty to really answer this.
My honest answer. First.
My honest answer is I don't know.
Yeah.
Nor probably does anyone else. But the first of all, you have to think about risk adjusted or inflation adjusted, et cetera, et cetera. One can argue that in principle, you would think the risk-free rate would include inflation, as would the market risk premium, and therefore that would wash and it would be the same. But, I don't know, nor perhaps does anyone else. So that's not a very satisfactory answer, but
I got to introduce Marty. Those of you watching will notice that we have been joined in progress by a good friend of both Bill's and mine. His name is Marty Leibowitz, and he literally wrote the book on the bond market a number of years or decades back called Inside the Yield Book. And he's also done a vast amount of research in equities, asset allocation, asset liability management, and I'm sure I'm leaving some large fields of knowledge out, Marty. He's also spent his life in business, where he served as either head of research or something like it at first Solomon Brothers, and then TIA Kraft, and then Morgan Stanley, from which he recently retired. He's one of the leading lights of the investment field, and welcome to this conversation, Marty.
Oh, thank you, Larry. Don't stop.
Well,
there's more. There's more.
There's more, but let's go back to the equity risk premium, since it was you, Marty, who brought it up in an email, and I was mentioning.
Well, let me tell you, there's some things that Bill's absolutely right, and you're absolutely right. No one knows what the equity risk premium is, and even trying to define it can get a little stretchy because you ask yourself, what is the risk premium relative to? However, one thing that you can do something about is to say, okay, what kind of risk premium would you require versus any baseline yield rate, in order to achieve a certain percentage of success over a period of time. And here's a number which I calculated a while back, which I thought was kind of interesting. If you got a 4% risk premium relative to the 10-year yield rate, okay, for equities, okay,
yeah,
and you took 16% as your prospective volatility, 1 year volatility, then the probability that you would have equities beat that 10-year yield rate over 10 years would be 80%.
Yeah, I've seen that.
So that's kind of a comforting number for a long-term investor, right? Now, what would that number be over 1 year with that same?
Can't be much over 55.
Yeah.
It'd be close to 60. So, which all of a sudden brings up another fallacy that you see in the market, not in the markets, but in the actual practice of finance and financial planning, is people they say, okay, I have to get 5% real. I hear this over and over again. You got a 5% real in order to maintain my planning for an endowment or a foundation. And then they say, if I can get 5% in the markets, I've basically got it. If I can get 5% real in the markets, I basically got it. No, what you've got is a 50% chance of getting it, okay? So it always seems to me that one of the things that people should do is not just look at expected returns when they're comparing relative to goals, but more like a 60% assured return, something which gives them at least a little bit more, first of all, incorporates some risk in the calculation, and then gives them a bit more of a reasonable level of comfort that they have a good chance of getting that goal reached.
Well, remember, it's easy to mix up ex post and ex ante.
Yeah.
If I get, in the sense of a realized result of 5% above the 10-year Treasury bond rate, I've got it. The problem is that I have no idea what I'm going to get. And that if the expectation is 5%, I think that's too high, but not grossly too high. I get much more or much less. Go ahead, Bill.
I was just going to say, as you might imagine, I spend a fair amount of my time with nonprofit investment committees or boards because they seem to think that I know something about investments, which of course you all know I don't, other than there's the market portfolio. But But the issue of the rate, and all the ones I've dealt with at least, just do it as what expected return are we going to incorporate total, not above riskless or anything. It's not that, they don't have that discussion usually.
They don't break it up that finely.
And you know what I've seen generally, and what seems to be considered acceptable, as I understand it, in various parts of the nonprofit world here and there, is more in the 4 to 5% total return.
Total nominal return.
Total nominal return.
Well, then they're going to have a very successful future because they're not budgeting for
On some years, yes, yes.
some years. Yeah, but
Now again, I mean, it depends on the organization, but I haven't seen the kinds of numbers that you'd get by doing a risk premium of 4 to 5%, especially in periods of high riskless rates. So, again, my sample is small, and it's highly localized to California, and even more so. But I think in the nonprofit world that I know something about or have had some experience with, it's not unreasonably high.
let me expand on my comment a little. The historical return on the U.S. stock market is close to 10, where the riskless rate is at around 4 or 5, and the rest is a premium. If you're expecting that going forward, you're more likely to be disappointed than if you're expecting only a total return of 4 or 5 going forward, which is why I said that your institutions that are expecting 4 or 5 are likely to have a rosy future, because they're more likely to get more than they're expecting than they are to get less than they're expecting.
But let me also not mislead. That's the spending rate,
Okay.
which is not thought of as necessarily the expected return. So that's by design probably less than the expected return.
Oh, okay. I thought you meant
They want to.
they were budgeting.
They want more than 50% chance of not having to dip any further in corpus.
Yeah, but that's a real rate, Bill.
No, I'm talking about nominal spending rate.
Well, nominal and real spending rates are the same. If you spend 4% of your corpus, or whatever you have at the time, this year, and the market goes up at the rate of inflation or some sort of non-zero rate, that 4% will be a bigger number next year, and so on.
Yes.
And so,
yes.
when I worked for the Ford Foundation and was partly responsible for this analysis, but we considered the 4%, 5%, it was 5% spending requirement to be a real requirement, and that we had to earn 5% real in order to have.
You wanted to maintain the corpus,
right?
Yeah. Larry, I think that I think foundations are actually required to spend 5%.
That's
and
right.
That 5%, as you point out, then becomes a real number. So the question as to what they have to get in order to achieve that is going to be something even on an ongoing basis on the order of 7-8%, which is starting to get moving into the heroic range.
Yeah, it is, and that's of course, foundations are under no obligation to survive forever.
They like the idea of it.
Yeah, right.
So, but
nobody lives forever, but the
foundations do.
Foundations,
or they aspire to.
Endowment
funds of universities.
So what I was saying is that most foundations, when they do their planning, they take and they'll say a 5% real, then they'll add on some inflation, average inflation number, say 3%. So their target is 8%. And in their minds, they think if we can get 8% on an ongoing basis, nominal, okay? If we can get 8% nominal, we're doing fine and we'll be sustained. They're wrong on that count just at the get-go, because that 8% is something which will only give them a 50% chance of surviving over a longer term period.
Well, I mean, they they think a lot about building the corpus. So, they think about how much they can spend without, they want to spend less than the expected total return.
So it gets worse.
And
It gets worse.
It gets worse because as soon as you start to get ahead and the corpus grows in real terms, you have people pounding on your door saying, "You're rich. Why aren't you giving me more money right now?" Which is when I need it. And then the question of intergenerational equity arises, and both in universities and foundations face that. But so do individuals, actually. I mean, when I spend money, it's money that my kids, it's that much less money that my kids will inherit. So we all have.
It's a double win.
What? Pardon me?
I was just thinking the same thing. You said it better than I would have. Yes.
I couldn't hear you.
It's a double win, Larry.
Yeah, right. Yeah.
But, yeah, I know. But, so how do you think about this question of balancing the needs of your current beneficiaries, who are all investment pools have been gathered to pay some sort of bill? So how do you think of what is best for balancing the present and the future?
Well, I'm not sure I get the question. Marty, you can answer it. I'm
yeah,
not sure.
right. Thanks a lot, Bill.
Yeah.
Here's one thing which I think is a useful way of thinking about things. In a defined benefit plan, remember those? You had funding ratios, okay? And that was the amount of money you have in hand now versus your present value of your relatively well-defined future liabilities. Yeah. But the very interesting construct, and it can be generalized. It can be generalized to what money you have in hand now, but instead of just taking your surely ill-defined liabilities, okay, and in some ways you're talking about what your liabilities are, Larry. If you just say, okay, let's say that you have some gauge as to what your liabilities are beyond just your stream of payments, but in terms of including contingencies, including whatever beneficiaries you want to add to, whatever contribution you want to leave to whatever good causes. Let's say that's your liability, a generalized liability. That generalized asset liability number, then asset liability ratio number, becomes a very useful thing for thinking about what kind of risk you should take.
But for example, everybody has their own take on that when you're underfunded, which most people are.
Right. So let's say that you're hugely underfunded. Let's say that your generalized asset liability ratio is 30%. Well, what do you do now? You got two choices. You can either say, well, I can't afford to lose any more money, and therefore I'm going to go to an absolutely zero risk strategy, or you can say, I can't afford to be here. I can't afford to live. I can't afford to go forward. I've got to take big risks and hope that it works out. This is what I call the lottery dreams scenario. And people do that. Look at, Bill, how about state pension funds?
How about them?
Lottery dreams, huh? They're taking ever more risk because they got to take more risk. You hear it all the time. I've got to take more risk because I got to get a higher return. There's a little illogic to that. Now, when you get
there's a whole literature, as you well know, on state and local, government pension funds, taking private equity and this, that, and the other thing, going for broke, if you will. But back to your case of old folks and children and grandchildren, to paraphrase it a bit, you kind of have a deal. I mean, the big uncertainty, unless you got some real honest to God annuities, the real uncertainty is mortality. And there comes a point at which you make an explicit or implicit deal with the kids, as to how much you spend, and if you give them money now, they may have to put you in the ADU in their backyard later on. So there's a whole interesting set of financial issues around that problem, which people of my age are cognizant of. Let me
Well,
just say.
my age too. My
I look forward to having those kind of problems in the future.
I was 39, so it's there are some advantages to starting a family young, but one of them is not that you're fairly wealthy while they're growing up. Um, so
We digress.
there's a very big issue in here, and I know, Bill, you've worked on this with your helping people do their financial planning through models, through software.
Actually,
Risk.
I think that this generalized funding ratio concept can be applied to the issue we're talking about here, because even including beneficiaries, you can incorporate that as part of your liabilities. And and if you want to go and take care of the next generation, first of all, to take care of the next generation fully, even for someone who's very well off, is very, very costly.
I can't. Yeah, almost nobody can do it.
That's right. Almost nobody can do it.
The problem is, I mean, as I say, and I don't want to overemphasize the mortality uncertainty, but that's a big component if you have not annuitized. If you've annuitized, Bob's your uncle, and you've got Social Security, which is, of course, annuitized. But and I think
if you annuitize everything, then your kids get nothing, and so partially annuitized seems like that.
So that's right, and you make your deals, and sometimes the deals involve, if I make it to age X, but no longer, you're good, and if I make it over X, you'll have to help support me, and if I don't make it to X, you'll get some money. So they're basically writing little life insurance policies for you, or annuity policies, more
They're
like.
writing annuity policies.
Writing annuities, exactly. And when you get that kind of shared risk bearing that goes on with the next generation, I don't think that's uncommon.
Well, also, though, unlike TIA, CREF, or New York Life, they're more likely to default on the annuity. They've got,
Yeah, but you might be able to default on it too.
they can. Yes, we've had
surprise.
two defaults on annuity issuers in the last.
Let me just say that at TIA, we struggled with this issue. We basically were in the annuity business, and in a fundamental way, that was really what our fundamental business was, annuities. And the one problem is, and it's getting more and more exacerbated, because mortality is becoming more of a problem, I say, because of longevity, because of people living much, much longer. And therefore, it's very expensive to buy an annuity that will really cover you for that period of time, especially after inflation. Even low levels of inflation will do a devastating job on you if you live 30 years beyond your retirement point, or beyond your annuitization point.
Oh, yeah.
So we tried very hard at TIA to develop a inflation adjusted annuity, and you know what we found? We found that we could finally do it by various torturous means, but that no one would buy it. You know why?
Too expensive.
Because they paid so little.
Bingo.
Yep.
There's only one entity that provides a inflation adjusted annuity that I know of, and it's very solid. But as far as credit is concerned, but there's some flakiness in terms of how the circumstances may change. You know what that is?
Who is?
The United States government.
Bingo. Social Security.
Okay. Well, yes, of course. Well, yes, and we know exactly what's happening, or not exactly, because the numbers are queer, but we know what's happening to that. It's coming up for its day of reckoning.
Yes, right.
And that's
just have a tax increase. I mean, the day of reckoning is going to be pushed back a year every year. And
one hopes. I hope, at least. Let me just say that.
Yeah, we're counting on that, right?
Well, no, I think societally.
There's an interesting story as to what happened with the Dutch pension fund ABP. Early in its period, it promised inflation-adjusted annuities to their retirees. Very, very well intentioned.
Mhm.
Then several years in, about, I guess, 10 years ago, it found that, we really can't afford that. We can't pay it. So they've shifted to a situation where they would promise to provide inflation adjustments if earned on the investments.
Oh,
So
really?
it was contingent, yes. And
I
that's
did
what they've
not
been
know
doing
that.
all these years, yes.
So they built a very complex option into it.
Yeah.
Well, yeah. Welcome. You're now an investor. You, the recipient of the beneficiary.
So I don't know anyone who, there's some pension funds that are very, very well endowed, that have high asset to liability ratios, that do basically provide inflation adjusted.
Let me, au contraire. Many, the vast majority still, I think, of government plans provide something, and they're not well endowed typically.
Okay.
Well,
fair,
the endowment is in
fair
the
point.
growing
Which
tax.
makes the asset liability number much lower than they think it is.
Yes.
Yeah, the endowment is in the present value of a growing tax base.
Yes, exactly.
If you live
Yeah,
in a state
And
of
they
economic growth, then you're probably fine.
exactly.
and they use phony numbers to make it look better than it actually is.
Well, of course, they pay several people fat salaries to figure out how to do that.
I
Well,
remember back in the days when I first looked into that, and I still see some of this because of local nonprofits and governments, etc. And actually, there was an interesting project which I'll tell you, it's gone. And we had funding for years, but it finally fizzled out at Stanford, in which for every single government entity that was part of the CalPERS system, which is almost all, City of Carmel, etc.,
Right.
we computed many things, including a market value of the funded ratio as opposed to the non-market value that was used by the actuaries.
Right.
And you could look it up online. You go to Carmel City, and the differences are amazing. I mean, the actuarial number, say for Carmel, would be, oh, you're 75% funded. The economic value would be, no, it's 50%.
Yeah. Oh boy.
And that's a typical kind of set of numbers.
Yeah, I'm aware of that.
And we thought it was a great service because we would put all the information on each of the entities in the whole CalPERS system, of which there are very, very many, and then do the economic calculations, if you will. And it's staggering.
What do you do?
You just go another year and hope that.
Let's step back a little. So we know about these problems. If either of you were going to design a pension system for the United States from scratch, let's say we get to keep Social Security because it's not on the table politically, but the rest of the pension system, what would it be? Would it be DB? Would it be DC? If you want to define those terms for the audience, would it be something that looks more like an insurance policy, Marty? What
DC is not
imagination go?
DC is not a pension.
No, DC is not a pension,
No.
but it's what we've got.
Can I just restate your question and see if you'll
please.
accept this?
Please.
What would you like your children or grandchildren to have in the way of a pension? Is that a fair restatement?
Well, let's say in the way of a pension is part A, and part B then would be in the way of a retirement.
Well, I mean, saving for retirement.
Yeah.
Financing retirement.
Somebody saving for your retirement, whether it's you or an organization. Yes.
Okay. Marty?
Well, thanks a lot, guys. I think that what you'd like to have, ideally, I'll take a DB plan that's inflation adjusted. That ain't bad, okay? And you could then have if you had that, you would have essentially
Security.
that we have a lot. You have an asset liability ratio of 1 on your well-defined your personal life liabilities. Okay.
That's right.
You may want to do more than that. You may want to, even as your grandchildren, may want to extend it to their grandchildren, or be able to increase their level of living beyond the calculated spending that they went into that calculation. So they may want to have some additional funds that they invest and so forth. Now, the problem is, where do you cut this off? Where do you cut this off? I mean, the question is what do you do? What do you do in terms of dealing with problems where you have 30% funding ratios? You're really just cruising towards a disaster in the future. And so there's only 2 things you can do. You can try to get more from investments, which is a mug's game, I guess they would say in England. Or you could try to say, okay, look, I got to either cut back on my liabilities one way or another, either in terms of cutting back on my spending or cutting back in terms of the range of things that I'm covering, the range of people that I'm covering. Those are very, very, very hard decisions to make.
Well, in principle, I mean, but don't you think that in some ways, we'll take Social Security. Social Security kind of makes a promise when you put your money in your 30s that you're going to get a proportional, risk-adjusted, inflation-adjusted, income once you retire till you die.
Right.
That's the deal, and I think my answer would be you got to fund it appropriately on the way in.
Well, yes. Yes.
Well, the system was designed, as President Roosevelt said, to not be actuarially sound.
You didn't say it that way, I don't think.
Oh, I think that he
did. Did he use that word?
Yeah. And then he followed that up, so that way no politician can ever cancel my damn system.
Well, it was designed to be self-contained. Is that perhaps a better way of putting it?
Yeah, something. Yeah. I mean, that's what was meant. I take your point.
It's designed to be self-contained in the sense that the Social Security tax is earmarked 100% for paying Social Security benefits. However, the Social Security tax is commingled with other taxes for the purpose of everything but the tax form. Mm-hmm. And we don't. Our money is fungible, and when you pay your taxes, you pay the sum of the Social Security tax and all the other taxes, and it's really just an accounting entry that differentiates one pool from the other. Now, apparently, it's against the law for the government to use non-Social Security revenues to pay Social Security benefits, but also they make the laws. So when they can't pay the benefit anymore without going into general revenues, they'll probably change the law, because the alternative will be 60 million people of our age marching in the streets saying you've got to pay it.
Yeah, presumably that we can march in the streets.
Yeah, every president who's
roll in the street,
who's promised to really take on Social Security has started and found no, that's sacrosanct.
No, so but Larry, you're absolutely right that what in your implication that what will happen once Social Security hits a wall is that they'll use general revenues to make up the deficit. That's what they will do and what they should do.
Well, or that they'll raise the Social Security tax, which is exactly the same thing.
Yeah, exactly the same thing. Yeah. So this question comes, our mutual friend Jack Traynor gave a talk at the University of Chicago, which we all laughed at way back when at CRISP. And the talk was, what happens when a governmental entity raises its taxes so high that people start to leave?
Oh, I didn't laugh. I mean, I wasn't present, but I never laugh at that question.
Well, that back then, it was summarily dismissed by most of the people in the audience because it was inconceivable. But the fact of the matter is that there are limits to taxation, and the limits are not just raising the rates, but maintaining the base on which you're taxed.
That's right.
for a city, that's certainly true, and it's also true for a country, I would think. So the real problem.
What happens is not so much that you have mass emigration to a lower tax country, but the people stop trying as hard to generate the revenue. If you're taxed at 70 or 80%, you're more likely to retire at a young age, and entrepreneurs aren't going to put their heart and soul into building $1 billion businesses if they only get to keep a few million.
Well, of course.
The friend who used to be down the street, Art Laffer, made a career out of saying it.
Yeah. Well, anyhow, I think we all agree that basically Social Security is not going to collapse when it ceases being self-contained. It will go on, but that doesn't mean there will not be problems associated with the increasing burden on the population, on the budget, on other things that the budget would serve.
Correct. Agreed.
But one thing that's going to save us partly is that we're not going to make a claim on the Social Security system forever, and that the next generation, the Generation X, is much smaller, and then the millennials are big, and so they'll pay. The system will move back toward being in balance for a while. But we just don't know what's going to happen if this current fertility crash continues. If there really is a generation coming up when the millennials retire, and they're a large generation, that's too small in number to generate the revenue necessary to sustain the system, then we'll have another crisis in 40 years.
I think somebody wrote a book about this sort of thing.
I am aware of several. Well,
Greener,
Pete Peters.
greener, fewer, richer, maybe.
Well,
I've heard of that.
my book is a sort of a general future book that tries to address every problem, so it doesn't address any. But it's still worth reading. So fewer, richer, greener. Please buy a copy.
I think it's absolutely worth reading. Anyhow. Enough of a plug. I'm not. What I want to throw out one thing. We talked about asset liability ratios. We started talking about risk premiums, and the risk premium is a numerator in a ratio relative to the volatility, which I think it's. I don't know what it's called. It was named for someone.
The reward to variability ratio.
Who disavowed the name.
That's what it's called. I
remember Sharpe Ratio. Bill Sharpe once said, "I didn't name it the Sharpe Ratio, and I don't like that name." Yeah, right.
You can always,
as long as they spell it with an E.
Rob posited an alternate universe in which somebody named Bill Blunt, instead of Bill Sharpe, discovered that the market was wildly inefficient. The market portfolio was the worst thing you could possibly own.
Well,
why don't we call it the Blunt ratio so that present company doesn't have to be embarrassed here?
Well, I started thinking about this subject. Just want to throw out a thought for you guys. I started thinking about. I mentioned to you that the Sharpe ratio, if I may use that term, is actually can be viewed as a Z-score. Relative to the probability of success. And if you take that Z-score and multiply it by the asset liability ratio, you get a very interesting, and then further multiply it by an adjustment for the time horizon over which you're talking about the volatility, you get a very interesting kind of number, which again is a Z-score of the probability of having someone with a certain asset liability ratio at the outset. What is the probability that he will achieve his, fulfill his liabilities over the specified time period?
Well, and also, what's the probability that he will exactly fulfill them, or come within 10 or 20%?
Well, one can make those adjustments.
Yeah,
but I think that would be, I see. I'm intrigued by your latest book, Bill, and.
What is the name of it for those who
retirement analysis?
Retirement analysis.
My ebook, yeah.
And scenario, yeah.
Retirement analysis. Yeah.
I'm intrigued by it, and it suggests that it's important to give people a sense as to where they stand in some sense relative to what the future that they are likely to face, okay, or probabilistically likely to face. And that's essentially, I think, what you were getting at. And one of the things that I was thinking is that it's hard to give people distributions of outcomes 10, 20, 30 years hence and ask them to make some sense of what that means for what they should do today. So why not take advantage of the asset liability ratio concept and try to incorporate those stochastic aspects into a current value and say, right now, I mean, you are at 30% of where you need to be, given what you what you think your life will be like, and or better yet, this is the distribution of probabilities that what your asset liability ratio will be right now, given what your prospects are, what you think you're going for. All of a sudden, you see yourself saying, okay, I got a 20% chance right now, and you can translate that into a probability of success. I got a 20% probability now of achieving what I hope will be success over my lifetime, or beyond my lifetime in terms of what my beneficiaries might be. And that's not so good. But if you say that you have a 20% chance of a 30% ratio, a 10% chance of a 40% ratio, but a 50% chance of a 60% ratio, someone might say, you know what, that's not so bad. Maybe I can make some changes along in terms of my spending or in terms of what I'm promising to the kids in order to bring that closer to the 100% level.
Or if I'm
Yeah.
there in terms of what I'm earning. That
May I give,
supply side here too. If you don't have enough money, you should do something that makes more.
yeah, I mean, a couple of sort of fundamental issues. People do not understand probabilities, present company excluded.
Right.
And that's one very, very big problem.
Yes.
And I'll tell you another problem in this context. When I was first working on that project, one of the first pieces of software I wrote, tell me, okay, how old are you, male or female? How old is your partner, male or female? And I will run this little program and show you this graph, which will show you year by year in the future, what's the probability, first, that you'll both be alive, second, that only you will be alive, third, that only he or she will be alive, fourth, that you'll both be dead. Nobody, my sophisticated friends, my wife's friend, nobody wanted to see that diagram. They did not want to look at that diagram. So, right there, and we're going to talk about financial planning and et cetera, taking mortality into account and it's the same thing with probabilities. People are terrible with probabilities and they don't want to even talk about them. We all know that. So it's just a really difficult problem when you've got this huge uncertainty. I mean, you've got to deal with, financially at least, the uncertainty of mortality. Not just when you'll die, but when. And
I've said many times is that a healthy annuity market is the only way to solve that problem.
Absolutely right.
You have to be able to pool your risk.
Okay, I can understand. I'm going to get this check. It's going to hopefully go up with inflation. And when I die, my wife will get 75% of that check. When she dies, it's over.
Yeah.
That people can understand that. And whether or not in an ideal world of people like us who would deal with all the probabilities and the uncertainty, and this and that, that's the best solution. And it really, for ordinary people who have better things to do than what we do, I think that's the solution. And the private mortality market, if you will, life insurance is still pretty healthy, but annuities are fading from sight. There are exceptions, as Marty said, and the big one, of course, is Social Security. But for most people among our friends, that's not enough.
Right. Not enough for most people.
Yeah.
I think you ask yourself. I mean, I think the thing to ask yourself is, what can we do that would be helpful to people? And if we can give them some, if we could find some kind of metric that would be akin to an asset liability number for individuals, okay? And admittedly, that's not easy. But if you could do that for them, and if they could get a sense as to whether they're at 30% or 120%, that would affect.
What's in the denominator, Marty?
The denominator would be their generalized liability, and that would be just
liability for how many years?
That would be over their mortality, their wife's mortality, and
so basically,
and maybe then move into how much of they want to do for their kids, which would probably not be mortality, but some cutoff. You
know. So the denominator might be, say, the price of an annuity.
It would be the price of a very broad annuity that covers a lot of payments, and contingencies, which is not just literally your life contingency. It's not just a stream of fixed payments.
You have to be able to buy it in order to use it as.
No. I'm just saying, no. You won't have to be able to buy it.
Well, then it's only at best.
If you could just measure it in some kind of crude way, you give people the sense as to where they stand and how much and what they have to do to possibly change their lifestyle, to change their ambitions of taking care of their kids for a certain period of time. They'd have to think about what they really have to do, what they really want to cover.
My point is, if it's a probability distribution, which if nothing else for mortality it is,
yeah,
then the expected return isn't a sufficient statistic. The value of insuring it is a sufficient statistic. But other than that, what do you use?
Well, what you have is you have a multiple stochastic process here, obviously, okay? Sure. I mean, in theory, okay? And if you could boil that down to a distribution which is of that asset liability ratio itself. What is that distribution? Okay?
People, my point is people, you start talking distributions and people.
No. But Bill, even if you just give them what is your expectation for that?
That's not sufficient because
it's not sufficient.
We're playing an academic game here.
No, going back to what I said even earlier is even for the foundation, don't go for 50%, go for 60%. If you could tell somebody that you have a 60% probability of covering a certain specified range of liabilities, okay, which are beyond your longevity and your wife, okay, and let's say that you have a 60% probability of achieving 100% coverage or achieving only 80% coverage. That would be a useful number to know. It could spark them to think seriously about either changing that liability structure, changing how they invest, or just think about what else they can do in terms of trying to bring things within the realm of reasonable achievement.
Hang on just a second. We have a dog problem. Oh, well, it's okay. I've got one of them in here with me, so it's not a 2-dog problem. So
it's not a 2-dog.
3-dog problem. You get a.
My wife and the other dog are outside. Joey and I are. Would you like to? Well, I'll introduce you later.
Well, there's some circularity.
The other dog, the dog that's causing the
I have
problem.
to raise an objection.
It's a puppy.
You cannot set your liability independently of your assets. I can sit around and say I need $2 million a year to live, but since I'm not going to get it, I might as well not say it. The liability has to be set in the context of some conceivable future in which you satisfy the liability. So I decide what I'm likely to get, and so that's the liability. Now, if I have a horrible medical bill that I can't pay, or a windfall gain on some asset that I own, or whatever, that changes the situation. But I think that the normal way for people to think about their liability is in the context of the size of their assets.
I'll just say one thing, and I can speak from some personal experience here. As people get really old, they learn to think probabilistically.
Yeah.
somewhat better than they did in their earlier life. People are terrible at probabilities. You've seen the experiments.
Yeah.
Doctors, in particular, are awful at probabilities, and
Oh,
but when you get to an advanced age, there's a particular probability that you think about, and you start thinking about little distributions of ages of your friends, and so I think it may become a little easier to talk probabilistically with really, retired people, let us say, perhaps
yeah.
with younger people.
Oh, geez.
We've had quite a wide-ranging discussion about retirement, the pension system, longevity, and its mirror image mortality. But we have a few minutes yet, and about between 5 and 10, depending on how long you want to talk. And I was wondering if there was a topic that had not been brought up that you'd like, either one of you would like to address at this point.
Politics is out. I hope.
Politics is out, but that's not.
It's been very heightened.
Should be okay. I got one.
First of all, what kind of dog do you have?
They are both Bichon Poodle mixes,
Oh, nice.
and we got them both from a national organization that works with breeders, and it's hellishly expensive, but they both turned out to be just fine. We went to the airport to meet the concierge who had brought the puppy in the cabin. We got them both as very, very young puppies, and so they're both Bichon Poodle mixes. One, they both have brown and white, but the older one is mostly brown, tan, and the younger one looks like she's going to be predominantly white. And of course, they don't tell you what the proportions are when they say they're a mix. So
Yeah, right.
you think a half, but it could be 3/4, 1/4, who knows? But
Maybe there's a 23andMe for dogs. They have a different number of chromosomes.
yeah,
They would get a different brand name for the product.
they're both great dogs.
Marty, do you have a dog?
I've had dogs most of my life. We don't have one now. Here's a question I was going to think. I'll ask you, Bill. Let's say, given the fact that one has a certain mortality limit, are you going to provide for your two dogs in some way?
Well, part of the problem is that our children either have nothing or have cats. So we have not had that discussion. I guess my assumption is that the surviving one of my wife and I will have to deal with that issue, and that it's not a decision that we have to really agonize over at the moment. But yes, I'm sure that would come to mind for a survivor. But if we both get wiped out well, we're not flying anymore probably, so it wouldn't be an airplane crash. We can't use that idea. But no, I'm pretty sure that I'm pretty sure one of our children in particular would.
Don't forget the dogs are listening.
Only one of them. Yeah. The other one outside the closed door.
Take care of.
Yeah, but I think it is interesting to raise the question, because I think it raises an interesting point as to where you cut off your sense of obligation. Okay, both for a government entity and maybe even for a foundation. Where do you cut off your obligation? Okay, where do you start this? Where are things where you would not feel that you have to take care of it? And in some ways, that starts to define what I would call your generalized liability.
Yeah, no, I take the point.
No, I don't want to be the person at the foundation who says we should spend ourselves down over the next 20 years because
I'll be gone.
No, the
They
trustees who say that are not trustees thereafter.
Yes.
Well, in general, the donors are appalled when they see what became of their foundations. So at least Bill Gates has sunsetted his foundation, I believe, 50 years after he dies. It was going to be 20 years after he died, but it somehow changed. And
Well, I'm sorry.
I
Go
can
ahead.
imagine that number getting pushed back again.
The structure of foundations is really kind of curious because they really have to spend 5% real, okay, by governmental regulations. That means if they have a windfall year, their spending has to, at least over a 3-year period, go up.
Yes.
Okay. So their liabilities are, are always increasing if they have successful investment results.
That's right. And that was an issue that we always wrestled with at the Ford Foundation. But we didn't come up with an answer. The answer is you do what the law tells you and hope that markets go up and support that amount of spending. And if they don't, then we'll figure out what to do, as we did in 1974 through 1979, when the assets got so low that it looked like the rational strategy was to spend the rest of the assets and close the foundation. The trustees voted to eliminate most of the expenses, cut the spending rate from a high, it reached a high at one point of 14% to
Wow.
5%. And that was called the Saturday Night Massacre. And most of the people lost their jobs. And then the foundation did well after that because we had the greatest bull market of all time.
That was John. What was the CFO's name at that time?
English.
Don?
John English.
John English, with that very, very, very dry sense of humor.
So dry you can barely figure out whether he was trying to be funny or serious.
Yes. Anyhow, let's go and apply that issue to the individual. As an individual gets wealthier and wealthier, more or less, is either his spending or the range of obligations that he feels he has, or that his relatives feel that he has, increases.
Yes. And that is what I was saying about you set your liabilities in the context of what assets you have or what you think you have. Because for most people, not the very oldest, the big asset is your future earning power or human capital. So yeah, you set your liability as being something aspirational, but not ridiculously aspirational relative to what you've got. And
I was.
Is that how people set their liability as personal investors?
I'm sorry?
Do you think that people are behaving in the way that I just described, which is to say my liability or spending plans are basically whatever I've got plus some hoped for gains? They don't set their liability independently because you can't?
I think that's right. But if you generalize it, they have their spending plans, but then, as they think about things about, what they want to do for others, it gets enlarged if they have any level of wealth.
Yeah, that's right.
So it may actually be more fluid than just their spending plans. I mean, the very thought that, as you see the bumper stickers, spending my children's inheritance is, I think.
Yeah. There's a point beyond which you shouldn't deprive yourself in order to give your kids a huge pile of money that they didn't earn. But most people don't have a huge pile of money to either spend or give away.
Right.
People have a little less than just enough.
Yeah, right. Yes.
On that note, we should think about wrapping up. Any final comments that you guys would like to make?
Well, I think that we should thank Bill Sharpe once again for his contributions earlier and currently to a better way of thinking about all this. I think he is one of the very, very rare individuals who doesn't have to work, who doesn't have to provide anything, who doesn't have to prove anything to anybody, and who can't help but do it anyhow.
There's sort of
That is off to you, sir.
vocal angelic music behind you.
Yeah,
Marty.
Marty, could you please
Thank,
repeat
thank
that
you.
comment and speak up?
Thank you for that, Marty.
Marty, I wasn't able to hear you. Could you please repeat your comment where you thank Bill and speak up?
Yeah, okay. I said that I want to salute Bill for being one of those very rare individuals who has no need to prove anything to anybody, either in terms of financially or intellectually, and yet still devotes himself to trying to do good things with his mind for the world, and in a way which is clearly laborious for him, sometimes for us, but is so well intentioned that I can only salute it from afar.
Well, Marty, thank you, and you know, both of you have contributed and are contributing mightily. I'm just a correction. I'm not doing much of any work in finance anymore, but except being on investment committees of nonprofits. But I'm doing other things. But in any event, both of you have contributed, are contributing, and I'm sure will contribute to the field in manifold ways, for which we are all very thankful. And it's been great fun being in the middle, on my screen at least, of the three of us.
Well, thank you, and thank you both for taking the time to talk about your thoughts and experiences with the audience, which we're just kind of starting Financial Thought Exchange. We've got about 5 interviews behind us, but I think this is a very special one, and hope to talk to both of you and see both of you again soon.
Ditto. Good day, gentlemen and viewers, and thanks to all.
Larry, thanks for setting this up, and all the best to both of you.
Talk to you soon.